This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and look at long-term finance. Long-term finance builds on your short-term finance from F1, whereby we saw short-term finance such as trade payables, overdrafts, short-term bank loans, and I think we also threw in there, was it debt factoring? I think it was, wasn't it? Long-term finance is what's now covered in F2. It's important for F2, but it's also important as well, I'd have thought, for your management level case study. Because in your management level case study, a lot of it will be about offering advice, won't it? So I'd have thought some good advice to a business would be, what form of finance do you use if you are looking for investment in a long-term project? So what you've got is that there are two forms of finance in the long term. Equity, whereby your shareholders invest money within the business, and in return for that, they get a share. We will look at the different types of share, be it ordinary equity shares and preference shares. We also have the debt, isn't it? That's whereby the business borrows money. So it takes money from either an investor, it may take money from the government, it may take money from a financial institution such as a bank, and it will offer there to repay that debt with some interest on top, okay, in its most simplistic form. We will go on to look at different forms of debt whereby there may not be repayment, and there may not be repayment in cash, but repayment in shares. Okay, so there's quite a bit to go through and look at. So if we pick it up bit by bit, let's go through there and look at equity finance. Bits of this I don't think will be all that new to you. You may have experience of it from your time out there in industry. But equity finance, as we said, is split into, is it your ordinary equity shares and your preference shares? Okay, again, this has been touched upon in earlier studies, but the key bit about your ordinary shares is that that gives the shareholder ownership, doesn't it? And if they have ownership, then they will have voting rights. So they will be able to pass votes at an annual general meeting, and they will therefore be able to either re-elect the directors or elect new directors. Okay. The key bit about your ordinary shares is that it is the highest risk because you get paid last on any winding up of the company. Likewise, you will also get paid your dividend after everybody else has been paid their return, which is usually in the form of interest. And therefore, if you have a high level of risk, then you will have a higher level of return. So what we will see later on when we look at your weighted average cost of capital is that when we work out the return for the equity shareholders, it is much higher than what you have with regards to the return for preference shareholders or the return for your debt holders. Okay. If you have invested in shares, then what then are the reasons, if you like, for the company having given you that share in return for your investment? Now, when we're looking at advice, we're looking at advice for the company, not so much the reasons for the individual or the investor. So if we look at the advantages to the company, the good thing there is that there are no fixed interest payments, are there? You know, when we go through there and service that equity finance, it's serviced via dividends, and dividends aren't obligatory. So it would be quite handy, wouldn't it, that if you have uncertain cash flows within your project, to go potentially with equity shares as opposed to debt, because if you have uncertain cash flows, it would be difficult to meet those fixed interest payments, wouldn't it? Okay, at least with shares, you have the option of restraining back that dividend. Okay, no repayment is required. So once the investor has invested within the business, that's it. They're never going to go through and get that cash back unless the shares are tradable. But the company is under no obligation to return that cash like they would be under, say, debt finance. Okay. I suppose we've touched upon that third one, haven't we? Shares can be disposed of if the company is listed. It's much better, isn't it, being a listed company, because that then means that your shares are more valuable because the shareholders have the option to trade them with other investors. Okay, so that's a bit of an advantage to the company, isn't it? Because it increases the value of the business. It makes it more valuable. The disadvantages: it is an expensive form of raising finance. I will talk a little bit later on about the various different sponsors that you must have to raise equity finance. But the key bit there is that there will be issue costs associated with it. And those issue costs are the most expensive that you have when it comes to issuing equity, prefs or debt. Okay. The other downside is that there's no tax relief on dividend payments. If you pay a dividend, that does not allow you to reduce your taxable profit, does it? So therefore, it might be more advantageous to go through there and pay debt finance or issue debt finance. So you pay interest, because as you pay interest, it reduces your taxable profits, doesn't it? If you issue new shares, then the disadvantage is that there is the dilution of ownership. Okay, so if you've started up your business in your own back garden or your own backyard, whatever it may have been that you decided to develop, it may even have been that you've developed a social media site in your university halls of residence, and you and your friends own that business. However, when you then issue new shares to the public as it becomes listed, then you dilute the level of ownership. So for that social media website set up within a university halls of residence, you could think about Facebook and Mark Zuckerberg and his friends. When they issued new shares to the public, so you or I, when it became listed in New York, their ownership percentages reduced. And I think Mark Zuckerberg's percentage reduced around about 22% from his much higher previous holding. Okay, but it's not a bad thing, is it? In the end, yeah, it reduces your percentage ownership from the individual's perspective. The disadvantage from the company perspective is if you have new shareholders, they may expect different dividends. You are more accountable, aren't you, to those new shareholders? So that's where the disadvantage is. The disadvantage from the individual is that they have less, if you like, voting power. But if memory serves me right, I think the new shares issued in Facebook were set up so that Mark Zuckerberg still had the majority of the voting power, even though he owned actually 22% of the business. But I'm not too worried about that. You can look into it further if you so wish. If you have a high proportion of equity, as we said, that's the higher risk investment, higher returns. And what that can do, as we'll see later on, is that can increase your discount rate, your weighted average cost of capital. And therefore, if it increases your discount rate, that will go through there and reduce your discount factor and will make cash flows in the future in your project that little bit less valuable, and therefore might reduce the present value of your project. Okay. So a couple of advantages, a couple of disadvantages. I wouldn't necessarily learn all of them. What I would do is I would just have them there to think about and apply within any question. Okay, you'll be given the answers within the question. You just need to see whether it's right or wrong. Okay, and then tick the correct answer. You might need to have more of an awareness of those advantages as it comes to look at the case study. But for now, I'm just focused on the F2 exam. With regards to your preference shares are sort of like a hybrid. They're sort of like in the middle, aren't they? That they're not equity because it doesn't give you ownership of the entity and voting rights. It just gives you ownership of the preference share capital, which is not much at the end of the day, and it doesn't give you any voting rights. Okay, but it's not debt. Okay, it's very similar to debt, isn't it? In that you are guaranteed, if you like, a fixed return, aren't we? Because you get your return based upon the coupon rate and the par value. Okay, but it's not as good as debt, is it? Because on a winding up order, you will get paid after the debt holders have been repaid. So there's a little bit more of a risk, isn't there, attached to your preference shareholders. So it sort of begs the question, doesn't it? Why would a company go through and issue preference shares? Well, what I would go through and think about that is the good thing about preference shares is that it does offer stability, doesn't it, to the investors. So by stability, we're talking there, aren't we, about the fact that they are getting a fixed return, okay? And those preference shares can always be redeemable as well. So you know that you will go through and get your money back at some point in the future. Whereby with your equity shares, there's no guarantee of a return, is there? Okay, you know that there's no guarantee that you will get a dividend. You would hope that you would, which is why you've invested within the business. But there's also no guarantee of capital growth. You know, if you think about your business not being listed, then you know you might never be able to actually sell those shares. So there's a bit of an issue there, isn't there, with your equity shares being unlisted. But here, preference shares, there's much more stability to the investors. And if there's stability for the investors, that should bring a bit of stability for the company, as it doesn't need to think about how it's going to pay any dividends to equity shareholders. Okay, it just knows that it has a fixed payment to meet every single year. The other one as well is that preference shares don't offer any ownership. So therefore, by issuing preference shares, there is then no dilution of ownership. And if there's no dilution of ownership, then hopefully there will be no dilution, is it, of your voting rights. Okay, there we go. So there are reasons why investors would prefer preference shares, and also why the company would prefer the preference shares. Okay, if you do a little bit of research, there's been quite a few companies that have recently issued them. They're nowhere near as popular as debt issues or equity share issues, but I think it's the Scandinavian airline company, SAS, I think it stands for Scandinavian Airline Services or something along those lines. It was in a little bit of financial difficulty, and it went through there and issued preference shares to the public, and they used the funds to get it out of financial difficulty. Okay, and the reasoning behind that was that it didn't want to issue equity because that may have changed the ownership, and the owners may not have been happy with the way the business was being run and changed the directors, etc. But they wanted to reward the people who invested within the business. So they offered, if you like, those preference shares, which gave them a little bit more stability. It gave them a guaranteed return, whereby if it was equity, there may not be the guarantee of the return. And if there's no guarantee of the return, then the equity shareholders may not subscribe for the shares in the first place. Okay, but that's just throwing in a real life example. Throw it into a search engine, have a look at issue of preference shares, and you'll find a few companies who you may be familiar with other than SAS that are more suitable to you. But that's just one that I've recently seen. Okay, we're just going to go through and think about equity with regard to listed and unlisted companies. If you are an unlisted company, so your shares are not traded on a known stock exchange, that makes it a little bit more difficult to raise your equity finance. So if you're an own and managed business looking for equity finance, that makes it difficult straight away, doesn't it? So always look at the type of business that you have within a question, whether that's F2 or whether it's the case study exam. Because if you are an own and managed business and you start waffling on about how you're going to go through there and do a brand new issue of shares, well, great, you know, that could be difficult, because it then needs to mean that you then become listed, and you might not be big enough to become listed. So there's little things like that you need to bear in mind. Okay, companies need to be large enough to become listed. You know, a small own and managed business might not be there yet. So if you want to issue more shares, it's going to be very, very difficult. Other reasons, I suppose, on top of, if you like, the lack of marketability, is that there is a lack of audited information. Maybe you are a smaller business, so an SME, and you're not large enough to have audited information, and therefore it makes it a little bit more risky, doesn't it, from an investor's perspective, because they would want to look at how the business has done in the past and then see that past performance has been verified by the auditors. if there is no audit background and audit checks that have been done, it makes any information that you produce that little bit less worthwhile, doesn't it? Okay. Doesn't mean to say unlisted companies are not audited. They will be if they are large enough. And again, the other one there is the higher risk of unlisted companies. It's just a general opinion that unlisted companies are risky, and correctly so, because they are not, if you like, subject to as many stringent rules and regulations, because they are unlisted, so they don't need to conform with stock exchange regulations. They don't need to conform to running the business in the way that large institutional shareholders would want the business, if you like, run how they would like it. So there's a little bit more of a risk, isn't it? That there's a much more, if you like, freedom given to the directors. Okay, and that just makes it that little bit more risky, because maybe the directors are the owners as well, because it's an owner managed business, and therefore they may have their self-interest threats, okay, or self-interests that they have within the business. So run it more for their benefit as opposed to the wider shareholder community. But as we said, once you have become large enough, exactly like Facebook and Apple did, they may then seek to become listed. Okay, why might you wish to go through there and become listed? Well, we've got loads of advantages, loads of disadvantages that you've got there. Again, I'm not going to say to go through and list them all. I think there's quite a lot to go through there and consider, aren't there? So have a read through them and check that you're okay. I don't think there's anything there that's too, if you like, difficult to understand, but let's just go through there and have a quick chat through them anyway, shall we? It creates a market for the shares so they can be bought and sold. So when Facebook listed, their shares were then able to be sold. So therefore, if Mark Zuckerberg had a lot of shares at some point in the future that he wanted to get rid of, he could sell them on the open market and make lots and lots and lots of money. And he did. Okay, and I think he spent lots of money on one of his significant birthdays. Okay, an enhanced status and financial standing of the company. I think that does go through and hold sway, doesn't it? Because you are now listed and everybody knows that you have to answer to the institutional shareholders, that you are complying with the rules and regulations of that particular market. Therefore, you know, people look at you in a different light, don't they? Okay. Increased public awareness and public interest. Oh, definitely true there. People knew a bit about Mark Zuckerberg first, didn't they, before they became listed, but now obviously they take a much bigger interest in how his business is run. Okay, and what they launch and what they change on Facebook. Okay, and you know, public awareness, public interest sometimes is not the best thing. Sometimes it can be great. You know, something happens, maybe there's a social media campaign on Facebook that really picks up steam, something charitable, it goes viral. It's great for the charity, but it's also, you know, good promotion, isn't it, for Facebook and the other social media sites. However, that there could be issues whereby maybe Facebook introduces something new into its product, or maybe Apple introduces something new. And, you know, you have people who love Apple products, don't they? And if you change it and you change it to something they don't like, whoo, all kicks off, doesn't it? Okay, everybody starts complaining, and you know, people start to complain. Shareholders pick up on it and think, well, hang on a minute, the sales aren't going to be as good as what we expected. And if the sales aren't going to be as good as what we expected, we're going to sell the shares. If you sell the shares, share price goes down. So, you know, you've got much more accountability. You do get access to more finance, don't you? Because you can issue more new shares in the future. So you could do a rights issue of shares if you so wish. And because you are more, if you like, with an enhanced financial standing and enhanced status, there are other potential securities that you could go through there and issue. So some fancy debt instruments. There's increased acquisition opportunities. I think that's one that you possibly looked at and thought, what's that about? Well, if you think back to group accounts, if you think back to goodwill within group accounts, particularly in F1, and think about the fair value of your consideration, then what you could do is a share for share exchange. Now, if you do a share for share exchange and you offer your shares when they are unlisted, it's not much really, is it? Because, you know, you don't know the value of the shares. That share isn't marketable. But if you're listed you really can go through and do a share for share exchange, okay? Because you know the value of the shares that you are issuing, and when you issue the shares to the shareholders of the subsidiary, they can then keep those shares and potentially go through and sell them on the market in the future, okay? I think Facebook has used some share for share exchange to go through there and acquire some other social media sites as well as just paying cash for them, okay? I think Instagram is possibly one of the big ones that they bought with regards to a share for share exchange. Because there is a market, the existing shareholders can sell the shares. I think we've mentioned that already. And then another one at the bottom, which I think is quite relevant, is that you now have more opportunity to reward your employees via a share option scheme. That's good because you can offer incentives which will keep the employees, and you can incentivize some of the key employees. And if you keep the key employees, that should hopefully increase the value of your business as they work harder, push up the profits, and increase the share price. Okay. Disadvantages. I think we've mentioned that there's an increasing accountability to the shareholders and the stakeholders. I think we've mentioned that already. Okay. You need to maintain dividend and profit growth trends. That's vitally important, isn't it? When you report back to your shareholders, particularly the institutional shareholders, they want constant dividends or dividends that grow, isn't it? That's why they've invested within your business. If you change that dividend pattern, they may go elsewhere. Disadvantages, rules and regulations, we mentioned that. Yes, it enhances the status, but it also is costly, isn't it? You might need a new department to administer the stock exchange rules. You might need to convert your local reporting standards into your international reporting standards. So that means there's going to be a lot of training and updating of systems, which can be costly. Increasing costs of compliance with reporting, I think that covers that as well. Disadvantage, we've mentioned before about relinquishing some of control of the company. Increased media interest, I think, that ties in with the increasing accountability to shareholders and stakeholders. And the one at the bottom, you are then more vulnerable to an unwelcome takeover. Okay, if your shares are listed on a stock exchange, in the UK, we had Cadbury's, makes fantastic chocolate, or at least it used to. But what happened there is Cadbury's was subject to a takeover. It didn't want to be taken over, but the shares were listed so anybody could buy the shares. And a particular company went through there and bought those shares within Cadbury's. And now Cadbury's is a UK company, but it is American owned. Okay. And there was not a lot that they could do about it. They tried to fight it off with various methods that you will see when you get to F3, but the success of the takeover personally has now meant that Cadbury's chocolate doesn't taste as good as what it used to, but that's a separate issue, so don't worry about that. But again, it's crazy that you say that. In the UK we have Cadbury's chocolate, you may not be aware of it, but they make these chocolates called cream eggs, which are obviously very popular around Easter time in the UK, because that's when we all buy eggs, go crazy with chocolate. And people bought the cream eggs recently and started tasting the cream eggs, and there was a lot of public outcry about the change in the chocolate. Since Cadbury's had been taken over, there must have been changes in the recipe. It's denied, but that there has been change. There has to be. People wouldn't just say, "Oh, this chocolate tastes different." It did, and that had an impact on people's appetite for cream eggs and whether they wanted to buy it. It's crazy, isn't it? But that's the world that we live in. People complaining about chocolate actually gets onto the news. There we go. Look it up on the internet. See if you can find it. Cadbury's cream eggs changes in recipe. Then what we've got, if we go over the page, if we become listed, how do we go through there and become listed? Well, you've got a couple of methods there. First one is a fixed price offer for sale. So all you go through and do there is you come up with a fixed price that you think the shares are worth, and then that is what you issue them at. You say, right, this is what the share's worth. This is what we're going to issue it at. If you pay it, you'll get a share. If not, you don't get a share. tough. But that could be tough on the company, because if the price is seen to be too high, then the shareholders won't buy it. So therefore, it may not be attractive. So it's quite a risky strategy, isn't it? Okay, and therefore the issue fails to raise the amount of finance required. It's like, well, hang on a minute, I've issued all these shares, I needed $20 million, and I've only got $15 million because I set the wrong price. I need to find 5 million from somewhere else. Where do I get that from? It doesn't just magic out of the sky, does it? Okay, so there's a bit of a risk. However, just note that risk can be mitigated by paying an underwriting fee. Okay, so to the merchant bank, they will turn around and say, well, look, if the subscription isn't successful, then we will buy up the remaining shares, but we will buy them at a discount. Okay, so therefore there's a little bit of a cost attached to it. Okay, so the other way around that, if you're a bit worried about working out the value of your business and working out the value of a share and worrying about the fact that the price that you set could be too high, you could have an offer for sale by tender. By tender, what does that mean? By bidding. When you tender for something, you bid for it, don't you? If you tender for a new project within a different company, you know, you're bidding against somebody else to try and win that business to perform that project. So to construct some buildings or to construct some other asset. So it's all about bidding for the shares. So what happens is you invite investors to come along and bid for the shares. But what happens there is that you then issue to those investors who have bid at a particular price or higher. Okay, so you will give a list of potential share prices, and then people will put in how many shares they wish to go through and buy at that particular price. The issue there is that we start off, don't we, at the highest price and look at the number of bids. If there are insufficient bids at that higher price, what happens then is that we then take those shares and begin to move them into the next lower price. And what we will do there is we will then issue the shares based upon either one, a desired amount of capital has been raised. Okay, so as we keep dropping down the share prices, when we get to a level of capital that we want, we then stop. Nobody else gets the shares. Or what we can do is maybe we can keep going and going and going until we get the maximum possible share capital that has been raised. This is a prime objective test question, isn't there? Looking at an offer for sale by tender, looking at the number of bids, looking at the share prices, and being able to see if we can go through there and get the right price or the maximum amount of proceeds. Okay, excellent. So let's just go through and have a look at the example that we've got there. Is it called ABC? Okay, and you've got the two parts to it. First of all, it wants the issue price at which we will raise 30 million. So that's a fixed amount of capital. And then the second one there is looking at where we get the maximum proceeds for the offer. Okay, so what you've got is you can see the list of prices down the side, can't we? 400 down to, is it $3? And what you've got there is the number of bids. Okay, so different people have gone in at different prices saying how much they want to go through and buy. Okay, so what we do is we start off at $4, so 400 cents, and there are two bids, aren't there? Okay, so 2 million bids. So here your proceeds would be there, is it, as 8 million, isn't it? Well, that doesn't raise 30 million. Is it the maximum possible proceeds? I don't know. We'll move on. But what then happens is, as we've not raised the 30 million, those 2 million bids will now drop into the $3.75 category. So if we look at your cumulative number of bids, I think you then have, is it 4.8 million. 2 million plus the 2.8. 4.8 at 375. Does that give me 18 million? So it's not the 30 million, but it's maximising my proceeds at this point in time, isn't it? If I then drop down another level to the $3.50 and add the 3.8 million to, is it the 4.8 million? 8.6 million, isn't it? I have 8.6 million shares at $3.50, which gives me 30,100,000, doesn't it? So in order to raise 30 million, the issue price there is $3.50, isn't it? Okay, that's the first one that gets me to that 30 million. The people who have bid at the $3.25 and the $3, tough. You should have bid higher and you would have got the shares. Okay. If we go on to $3.25, does that maximise our proceeds yet further? Let's have a look. 8.6 plus 1.7, 8 and 1 is 9, 10. 10.3 million is that. So 10.3 million at $3.25 gives me 33,475,000. So if I went a bracket further, so another price bracket down, that will give me 33 million at a bit, which is looking to maximize my proceeds yet further. And then at $3, we end up, is it with 10.8 million cumulative bids, and at $3 I think that gives me, is it 32.4 million. Okay, so when I want to go through there and maximize my proceeds, that's my maximum proceeds that I get, and to maximize my proceeds, the $3.25 would be the price. Okay, excellent. There you have it. Have a play around with that example, work it again. There's usually 1 or 2 examples in whichever revision kit you decide to use. Sort of thought there that it's quite a good topic to cover and to get yourself one of the objective test questions correct within the exam. Okay. The last 2 bits to do with your equity are there, going through and looking at a private placing. So a private placing removes all of this offer for sale by tender and a fixed price offer. You know, that tends to be, doesn't it, to the general public and any institutional investors. Here, private placings are sold to institutional investors. So you directly approach pension funds, insurance schemes, large merchant banks to buy those shares. When you do that, it makes it a little bit cheaper. Okay. The other one is a stock exchange introduction. That's whereby no capital is raised, so you don't have to issue shares and get cash. Most of the time you would do, but you could, if you like, decide to start listing your shares and not raise any additional capital. Okay, the reason why you would do that is, okay, maybe you don't need the capital, but you can then go on and dispose your shares on the open market at some point in the future. Okay, excellent. So that's everything to do so far with your equity finance. I don't think there's anything there that's too major to get you upset in any way, shape or form. What we've got over the page is then looking, is it at your debt finance. Okay, debt finance, vitally important that when you're thinking about your debt finance, is that the debt, the interest is tax deductible. That is important there because it makes it cheaper than the other forms of finance that we've seen with regards to equity, be it ordinary or preference shares. And also as well, your interest must be paid prior to your dividends, and therefore, okay, that makes it a little bit more financially secure, doesn't it, from an investor's perspective. But from a company's perspective, it's a little bit more risky, isn't it? Because if you don't have the funds, then it makes it a little bit more difficult to meet those payments. Why would you go through and take out debt finance? You know, the prime reason is because it is cheaper. But as well as considering the fact that it is cheaper, also things to consider are things such as security. So what you have there, security, is whereby if you default on a payment, then if you continually default on the payment, then whoever has lent the money to you can go through there and have a right to your assets. Okay, they can take those assets, liquidate it, and get the cash back in an alternative fashion. Okay, so if you have lots of security, that's good, because it can be used to secure that debt, and therefore that makes it less risky from the lender's perspective and can reduce the rates of interest. So if you are a heavy manufacturing industry, you will have lots of security, won't you? You'll have lots of tangible assets and lots of inventory. However, just be aware, if you're, say, a non-capital intensive business, so maybe you're an advertising agency or a recruitment agency, there's not many assets there that they have that they can use as security. Okay. Just note there are two types of security: fixed and floating. Fixed security is security fixed against a specific asset, so maybe your head office or some form of land and buildings. Floating is against, if you like, your general assets. So normally there you're thinking as your inventory. Now if you've got security against a fixed asset, so a specific item of PPE, you can't sell it. Okay, but if it's floating against, say, your inventory, you can sell it in the knowledge that it will then be replenished as it is then sold. Okay. The other one that you've got there are looking at your covenants. Again, covenant is just another way of limiting the risk to the lender, and what it does is it restricts the actions of directors. It's like a preventative measure to stop you, if you like, getting too in debt and therefore paying out too much interest, so therefore reducing the risk to the lender. Okay, there's just a couple of examples there as covenants. You've got dividend restrictions, so maybe the lender says, well, look, you can only pay out a certain amount of dividends every single year, because if you keep paying more and more, that then means that there will be less cash to pay interest in the future. Okay. Could be restrictions on your financial ratios, so maybe your gearing or your interest cover needs to be set at a particular limit. So your interest cover looks at how many times you can pay out your interest from your profits. Maybe you need to keep that interest cover above a particular level so that the bank is comfortable that you have enough profits to pay out your interest. Gearing measures the level of debt compared to the level of equity. The more highly geared you are, the more debt you have, and therefore the more risky that is as you introduce fixed interest payments. It could well be that the covenant restricts you to below a particular level of gearing to prevent you taking out too much debt. Okay, because if you take out too much debt, you have to pay more interest. And if you're paying more interest, that is risky to the lender, isn't it? And then there could just be simple restrictions that the bank has lent you the money and they say, right, that's it. You can't lend money from anywhere else. Okay, so there is an issue there that they will prevent you from raising further debt finance. Okay, so they're just a couple of examples. Be aware of them to back it up, I suppose, in your case study with examples of what covenants could be. Okay, when you're looking at the different types of debt finance, there's two to consider. There's the typical bank finance. That's the main form of debt finance for a lot of companies, isn't it? Approaching the bank and taking out a term loan for a fixed period of time and repaying the interest. Okay. When you're going through there and looking at, is it your other alternative? That's looking at traded investments. So instead of approaching a bank and getting them to lend you money, you will go through there and approach either a broker, an investor, and you will say, look, I need to raise $10 million. Can you do that by a form of a debt instrument for me? And therefore they will go through and find a collection of individuals, various investors that will come together and put the money in and lend it to you. Okay. what will then happen is that you then receive the money, they have the debenture, they have the loan stock, and then that debenture or the loan stock can be traded on the market. Okay. If it is traded on the market, just make sure you're aware of those typical features, because we'll see that quite a lot. Each debt is denominated in units of $100. So shares are denominated as dollars per share, aren't they? Here it is $100, and that $100 is per 100 debentures. So each debenture has a value, a par value of $1 each, but we don't quote it based on its dollar value. It's done on a $100 value. So that's something important to be aware of. It's just different to shares. As I said, shares are done in dollars per individual share. This is done on $100 for a 100 block of debentures. So 100 individual debentures have a par value of 100. It's a bit quirky. It essentially means that each one has an individual par value of $1, but we look at it based in hundreds. Okay. And then what you've got, interest is paid at a fixed rate. That fixed rate is the coupon rate. So you agree a coupon rate based on the level of return and the level of risk that the investor expects. And it's the coupon rate multiplied by the par value. So let's just say you had there, was it a 10% coupon rate? The par value is 100. So the interest would be, is it there, 10 per 100 block? Okay. No, if you like it, it's 10 cents, isn't it, per debenture? But we don't work on a per debenture. It's on a block of 100. So 10% of the 100 is $10. Okay. And again, traded investments, they have lower risk than ordinary shares, and may be protected by the charges and covenants. So when we're talking about charges, we're talking about security. So just because it is traded doesn't mean to say that there can't be security and there can't be covenants. Okay. I'm talking charges, it's talking about fixed charge, floating charge. Okay, so a little bit of tricky terminology. Hopefully you'll get used to that as we go along. Okay, and then something else to bear in mind, what you have is those traded instruments. There are three types. You have redeemable. So if you issue redeemable debt, then that will need to not only pay the interest but also repay the cash. If you have irredeemable, then the amount that you borrow never ever needs to be repaid. If that's the case, then as there is no repayment of the principal at the end, maybe you need to adjust the coupon rate to compensate for that lack of repayment. So maybe there will be a higher coupon payment that you make every year. And then the last one that you've got there is your convertible. It's a very fancy, neat bit of debt whereby it's a special redeemable debt. Redeemable debt, you need to pay it back in cash. To pay it back in cash, you need to find the cash to make the payments at however many years in the future. Convertible debt is very savvy in that what it does is it offers the debt holder the option on redemption to either take the cash or take the shares. You hope they'd take the shares, wouldn't you? Because that will go through there, won't it? And prevent you having to find the cash to pay them. How would you incentivize them to take the shares? Well, increase your profits. Use the funds from the issue of debt to invest wisely, to generate profits. The higher the growth in profits, hopefully that will feed into the share price. And then the higher the share price will then be a better alternative than taking the cash, wouldn't it? Okay, so therefore we need to go through and think about convertible debts and whether or not the holders would take equity shares or redeem it for cash. But just be aware, the three that you've seen previously there is your redeemable debt, irredeemable and convertible, because we will talk about those further when we come to look at your weighted average cost of capital calculations. Okay, other than that, I'll see you all a little bit later on.